안녕하세요. 한경글로벌마켓 애청자 여러분 반갑습니다. 2025년을 맞아서 뉴욕의 부동산 투자사 브릿지인베스트먼트를 찾아왔습니다. 여기에 회장님이시자 창립자인 로버트 모스 체어맨을 만나러 와서 저희가 인터뷰를 하겠습니다. 제가 5년 전에 인터뷰를 한 적이 있는데요. 다시 한번 만나게 돼서 너무 반갑고요. Nice to meet you again.
Very nice to see you and welcome to New York.
Last time we spoke and I wrote article headline like don't buy New York office building, something like that. That advice is still applied. Many Korean investors lost their money when they invested in the office building in New York, especially Manhattan. And before we interviewed, maybe the price is falling. Might be it's a good time to buy at a discount.
U.S. real estate market has many different aspects to it. There are different sectors of real estate. Some have, in our view, really solid, strong, secular tailwinds behind them. And some are more questionable. We don't count office as one of those that is most attractive today. What we think is most attractive in the U.S. is residential rental assets, because the U.S. has a meaningful housing shortage and a growing population, as well as logistics, because the U.S. has infrastructure needs, and with the growth of e-commerce and onshoring and reshoring and the renaissance of manufacturing, logistics assets are in high demand as well. There are other sectors that are attractive also. I think that our view is that office is further down in the list and not as appealing today. Certainly, many office assets have declined in value. The real question is, have they declined enough such that it's a good time to start investing again in office, and what the returns might be? To our view, the returns in other sectors are more attractive today.
The Fed has been cutting the rates. Do you think they will keep cutting rate next year? I think if the rate falling down, might be real estate market will recover some more.
So the U.S. economy has been very strong. You've had good growth. You've had growth in productivity. Inflation seems to have stabilized in the 2.5% range or so. Because of that, the likelihood that the Fed will engage in a multiple series of rate cuts, we think is diminished. Fed has cut rates. Fed is expected to cut rates by 25 basis points shortly as well. What's happened to the interest rate curve is pretty interesting. Longer rates have crept up a bit, while short-term rates have come down because of the rate cuts. And so the yield curve has gone from being inverted to being more normalized at this point. And with the subsequent rate cut, probably we'll have a positively sloping yield curve, or close to a positively sloping yield curve. I think that it's dangerous to compare what's been the case for the last 10 years up to 2021 with what might be the case going forward. We lived through an era of very low interest rates, almost zero interest rates. And that was an historical aberration in a lot of respects. When you look back over a longer time frame, generally speaking, the real rate of interest has been about 2%. Today, if the 10-year Treasury's at 4.2% or thereabouts, and inflation's at 2.5%, you're close to a 2% real rate. We think that it's very possible to find very attractive investments in real estate, use leverage appropriately in the current rate environment. Of course, if rates go down, it could make things more attractive, but you have to ask yourself also, why have rates gone down? If rates have gone down because the economy is weaker, then that's maybe not so good. And it's hard to understand why, in the absence of a weakening economy, you will see the Fed be as aggressive as some people hope it might be.
And you interpret the Fed cut the rate because of the economy gonna weak?
No, I don't think so. I think the economy is viewed by most observers as being pretty strong and pretty consistent. The initial rate cuts, I think, were a product of the recognition that rates had risen dramatically, and so some moderation was appropriate. But what the future holds in terms of incremental rate cuts, I think, is highly dependent on what economic data shows. And when you think about what the Fed's tools to manage the economy are, the primary tool they have is cutting or raising rates. Why use that tool when you don't need to if the economy continues strong? I saw some data recently that looked at the relative performance of the U.S. economy across various sectors compared to the European economy. And the U.S. economy has been exceptional in its performance. So the Fed has done a good job, we think, of navigating to a so-called soft landing where rates have come down a bit, short rates have come down a bit, probably will come down a bit more, but then you'll get to a nice normalized yield curve that provides a consistent environment in which to do business.
In that case, the 10-year yields will not coming down much, right? What is your expectation for the 10-year yield by end of next year?
Well, I think if you asked a lot of people, you'd get a lot of answers in that respect. I was at an alternative asset investment management conference earlier today, and one of the questions polled of the entire audience is, where will 10-year rates be at the end of next year? There's been a lot of volatility, even over the last 6 months or so. 10-year rates were as low as 3.65%. They were as high as 4.5%. It's hard to predict. If there's a 10-year rate in the 3.75% to 4.5% range, that is very conducive to finding excellent investment opportunities and being able to execute on those. One of the very important characteristics of the credit markets, in addition to rate, is availability of capital. There have been some pretty dramatic shifts in the appetite of bank lenders. Local banks, regional banks, national banks have, for the most part, diminished their appetite to lend to help finance real estate activities. However, the rise of private credit funds has offset and then some. So while we have a different composition of lenders, there's a free availability of credit at this point. We often securitize in the securities markets portfolios of assets that we acquire. We recently completed a securitization. It was completed at some of the tightest spreads that we've experienced in our 15-year history or so. We think that we have conducive markets. We have conducive equity markets, conducive fixed income markets, a significant institutional appetite to invest in selected areas of real estate, and that all combines, in our view, to a positive environment in which to do business.
Do you have any connections or acquaintance with Donald Trump? He was working in here in New York in same field.
Donald Trump, in his past life, was a real estate investor and real estate entrepreneur in New York, and in fact, he still continues to own assets in New York. I think the general view in the aftermath of the most recent presidential and congressional elections is the incoming administration will be conducive to business in the U.S., market friendly, which presumably will enhance opportunities.
His policy will affect a lot of aspects of economy and market. His actual tax cut or deregulations will help the market and the economy. But his tariff and immigration restrictions will hurt, might be. Do you think he's gonna push that policies get through all the way?
With between the Trump administration and other world leaders about how to conduct business going forward, I think it's very premature to have a particular perspective on whether tariffs will be implemented, how they would be implemented, what the objective of tariffs would be. In my view, the will to address the immigration issue, which has been largely an unmanaged issue in the U.S., I think the will to address that issue and hopefully address it in both a disciplined way and a sensitive way is going to be one of the defining aspects of the incoming administration.
Inflation and rate is very important factors in real estate market. Do you expect that inflation will coming down persistently next year?
Right now, we're at about a 2.5% inflation rate. I think the enunciated Fed target is 2%. Of course, there's some flex between 2 and something more or something less. So the Fed has done a good job of achieving its goals. The drivers of inflation are many. Productivity is a great tool to drive down inflation. Right. Some parts of the economy have experienced more inflation than others, but we have such a productivity and technology and artificial intelligence boom that you would think that there's some movement that could be made with respect to inflation. As it relates to inflation impacting real estate prices, we think that we're at a very attractive juncture in the real estate markets. When you think about it, after the global financial crisis, which ended in 2009, real estate prices were deeply depressed at that point. And there was a meaningful discount for existing assets versus what it would cost to build new assets. And that made acquiring existing assets very attractive. In the ensuing years from 2009 through 2021, as prices for real estate assets rose, so did construction costs, but gradually and fully, the discount of existing assets to new assets disappeared, it dissipated. And so investors were buying assets at the same price that at which you could build a new asset. What's interesting is since 2021, the price of new construction has continued to rise. The price of existing assets has declined on average about 20% or so in the ensuing couple of years. So that discount has reappeared, and it's, in our view, now about a 30% discount. You can buy existing assets at a 30% discount to what it would cost to build a new asset. So we love that as an entry point into the real estate markets. We think it has echoes, if you will, of the aftermath of the global financial crisis, where we and others earned very good returns in the real estate markets. And so we're quite excited about the opportunity set that we see in front of us.
And housing prices will going up next year. I think inflation will hold somewhat firmly because of the policy mix and all the tariff things, something like that. Actually, in the construction part, the immigration, some labor comes from the immigrations. I heard that kind of about 20 or 30% of labor, construction labors from the immigrations. And if restrict on the immigrations, it will affect the price of housing market, I guess. What do you think?
I think prices, certainly for commercial real estate that is bought for investment purposes, the two factors that influence value are rents and operating income on the one hand, and cap rate on the second hand. And so in a strong economy, whether it be for industrial assets, whether it be for residential rental assets, in a strong economy, you should anticipate that rents will rise. For individual assets, what happens to rents is a product of the location in which they're in, what the market rent increase or decrease is, whether people are moving to that city or moving away from that city, whatever, and the characteristic of the individual asset, whether it's modern, whether it's attractive, whether it has the right physical attributes that attracts tenants. So we are bullish about rent growth looking forward because we're working in a strong economy, and we think that we buy assets that will outperform in a lot of respects. The other determining factor is cap rates. You know, whether if an asset's valued at a 4% cap rate, it's going to sell for more than an asset valued at a 6% cap rate. And our experience has been there's a great deal of global demand for exposure to U.S. real estate. There's exposure from U.S. investors. There's exposure from Korean investors, from Middle Eastern investors, and across the globe for good, valid reasons. And so we think that we will see a conducive cap rate environment as well. And that translates to a situation where you have stable, maybe decreasing cap rates, but certainly stable cap rates, growing NOI, and therefore increasing values. We as a firm believe that real estate is a highly differentiated asset from investing in public equities or investing in private equity or other things. And that if you own and operate the real estate that you acquire, and you're proactive in terms of those operations, you can create incremental alpha at the asset level, incremental NOI, which will further amplify value. And so we're forward integrated into property management. We manage almost everything that we either acquire or develop, and we think that adds incremental value to our activities.
That means you believe the environment around the housing market next year will be favorable, right?
We think so, yes. And we're investing with that view. Now, you also have to recognize that the United States is a big country, and there are some cities and some states where people are moving to, where companies are migrating to, and there are some cities and some states where people are moving from and companies are leaving. So there are a lot of specific regional factors that come into play as well. And so having both a national perspective on the one hand, but local experience and expertise on the second hand, we think is important as you try to discern where to invest, where to avoid.
I remember you talked the same way 5 years ago, and you recommended us invest in the Dallas or Georgia, Florida, something like that. And the demographics in the New York is decreasing, you said. It's the same situation 5 years ago now?
The same general situation, but some of the actors have changed. We still like the investment thesis in states where there's population growth, where there's business growth, where there's a low cost of living, where governments are less intrusive. We avoid states and cities where the opposite is the case. As a practice, every quarter, our very data-driven research team will force rank the 100 largest MSAs in the US, and it helps us to prioritize where we're looking to invest. But generally speaking, the so-called Sun Belt in the US, along with a number of exceptional high-growth cities on the East Coast, on the West Coast, are the areas where we invest.
And you talked about later the AI. With the AI boom is driving a lot of data center construction right now. Do you think this trend will last, or could it be a bubble?
Well, it could be a bubble. There was a survey recently that looked at corporate AI spending and whether the CEOs of those companies were satisfied or dissatisfied with their AI spending. And the vast majority of those CEOs were satisfied, either strongly satisfied or just satisfied with their AI spending. And so that suggests that there's strong fundamental reasons why the growth of AI has been strong and may continue. There's obviously a lot of different manifestations of artificial intelligence that impact company operations, that impact personal life. So in our view, not a bubble, not yet. There may be. There's a lot of capital chasing data centers. Data centers are a hybrid real estate product. Some of the value is in the real estate. A lot of the value is in the technology as well. And so you have to make sure that you have the right technological profile to succeed in the data space.
Do you think the US-China relationship will keep getting worse?
There's a lot of friction between the US and China at this point. It seems like it's in both countries' interests to resolve as much of that tension as possible and find cooperative areas of growth and success together. So you have a new administration coming into the US, and there's been reported to be some enhanced dialogue between the countries. So we'll see, but certainly I think that both countries would like to find mutually acceptable solutions that result in more cooperation, less conflict.
Chinese companies like Temu and Shein are investing heavily in the US logistics facilities. What do you think about this trend, and where do you see it going?
I think demand for logistics is very broad-based in the US. You have demand from non-US companies that are seeking to do business in the US. Chinese for sure, but not just Chinese. In a lot of respects, you have demand from domestic companies as well. Demands of the market continue to evolve and continue to accelerate. Most e-commerce participants today expect same-day delivery. So that puts a real premium on having nearby logistics and distribution facilities, industrial outdoor storage, warehousing, van and truck terminals, etc. So we think that demand is very durable and will continue.
And you talked about how important demographics when investing in real estate. Many developed countries have a very low birth rate right now. South Korea has the lowest one in the world, and the population is also aging fastly. What impact do you think this will have on the Korean real estate markets in the future?
Fewer people, generally speaking, is not a positive for the real estate market. And there are a lot of interesting demographic studies that have been done that look at the longer-term impact of low birth rates, whether it be in Korea, whether it be in China, Japan, or elsewhere. Those are big structural issues that have to be addressed both globally and by each individual country.
And you're not going to invest in that real estate market, right?
We have been offered opportunities to invest outside the U.S. a number of times in Europe, in Asia, more recently in Saudi Arabia. One of the things that we feel strongly about is if we're going to have the privilege of managing somebody's capital to invest, we want to make sure that we have a highly differentiated and competent suite of operations that allows us to outperform where we invest. And today, our investment capabilities are really centered in the US. Those may evolve over time. It's not to say that there aren't other great markets to invest in. I think anybody who knows Korea can only be impressed by the achievements of the South Korea as a country since the Korean War, the growth and the sophistication and the infrastructure that's been built. So, in my view, you never bet against Korea because that's a losing bet.
Thank you very much.
Thank you very much.
Yeah.